Friday, 11:59 p.m. Don't forget the flash sale ends for the programs on building your wealth. A link down below. Whether you're getting into real estate, stocks, you want to earn more money, join the Elite Hustler live streams, you want to get lifetime access to the programs, link down below, 11:59 p.m. Check them out. See what you like. And if you have questions, email us at kevin@meetkevin.com. Or if you'd like a custom bundle, email us as well at kevin@meetkevin.com. Now we got to talk about the madness of the dot-com recession and how it could potentially relate in similarity to the recession that we might end up seeing here. Obviously, we got a terrible PPI report, which is very, very scary, and suggests that when you have a bad jobs report, bad CPI report, a little bit hot on CPI with pretty sticky inflation in some of the parts, and then a horrible PPI report, it either says the January data is rigged thanks to seasonal adjustments, or things are actually getting bad again. Maybe that second wave of Michael Burry inflation is actually truly coming. And something we have to look at is potentially this Jeffries piece, which talks about the world of sticky tightening in the face of sticky inflation. And Jeffries aligns our potential recession that we're walking into now with the dot-com bubble. And I'll tell you, there's nothing to ruin a bull's day more than you talking about the dot-com bubble in relation to today's potential bubble popping in 2023, because we've only been suffering this pain for about 1 year and 2 months, 14 months, relative to the over 30-month dot-com bubble, which means you're potentially only halfway through the pain. And maybe when consumers do end up running out of money eventually, that's when you end up seeing not only the revenue declines at companies, but you also see EPS declines as producer price inflation ends up remaining hot. Now again, it's weird. It's really weird because when you actually look at the earnings calls of some of these companies and you look at companies like Pepsi, what do? They complain about higher wages from a year ago. They complain about higher input costs into their soda pops, but they talk about not actually being able to raise prices anymore, not planning on raising prices anymore, that they're just working through the lingering effects of the increases in the embers of inflation, but there's not enough elastic demand to continue to support higher consumer prices. But that's just trying to soften the bear argument, but let's see what the bears are saying here. Jeffries says neither the labor market nor inflation is necessarily behaving as the equity markets would wish. Both are not cooling fast enough, and you have a deeply inverted yield curve and quite a weird correlation between in the bond market, and that this cycle is oddly similar to the 2000 to 2002 tech bubble crash. We bottomed and kind of drug along the bottom between September of 2002 and March of 2003 when the Federal Reserve finally broke things and actually fully had to U-turn and sort of bail out markets, and then we sort of hit a bottom. We hope we don't have to go through that again where the Federal Reserve goes so far and breaks something, but so far the bear case today, pretty dang loud, especially after those PPI numbers. But what do you have here with Jeffries saying? Jeffries is saying that January US CPI was mostly in line with expectations, although you did have year-over-year numbers slow just enough to still be considered, in their minds, slightly disinflationary. However, they don't believe that's going to stop the Fed from hiking rates in March and probably or potentially in May. Instead, they actually believe that the CPI report points a picture of being very sticky at the core and no longer rapidly slowing around the edges. Now, you could end up hoping for more slowing around the edges if you actually get housing come down, given that housing made up about half of all the inflation that we saw in the CPI report for the month of January. But you have declines in core goods fading away, right? You don't have those declines coming in as fast anymore. And Jeffries warns about potentially the fact that we're going to end up going into a profit recession, much like that of the 1970s. And when you start talking 1970s and dot-com bubble, you're basically a bear. But they could end up having a point, because consider the following, what they mention. I'm going to read this paragraph here because I think it's very useful. Presently, the bulk of companies that are generating sufficient nominal profits to service debts and dividends are averting a credit recession, while at the same time the labor market is slowly being shed to protect margins. So in other words, right now you're basically saying, look, companies are seeing revenues maybe stall out, but the reason they're able to kind of keep going is because they're trying to do whatever they can to protect their margins. Fine. But how long does that last? Well, it's a concern. It's a concern on two folds. One is actually debt restructuring. Because of the substantially inverted yield curve, any kind of debts that you had from before 2022 that have to end up getting refinanced in 2023 and 4 are going to lead to a lot more of a debt cost for you. So companies that have a lot of debt and at the same time are seeing their inability to potentially raise consumer prices more, but are seeing their producer prices go up, could potentially end up facing bankruptcy or restructuring, particularly according to Jefferies, along the lines of unlisted firms. And they believe that because of this, you actually end up seeing a substantially strong argument that said, and I'm kind of going to summarize this Jefferies article a little bit because they talk in tongue that's a little bit complicated. And it took me a few reads just to be able to try to simplify it. Basically, what they're saying is, look, companies' expenses, even though they're cutting in some places, companies' expenses are going to rise. It probably should look like that. There we go. Companies' expenses are going to rise thanks to higher refi costs on debt and sticky inflation at the core for especially in producer prices, right? As we saw in the report today. On top of that, this market is starting to look eerily similar to the 2000 to 2002 bubble, where basically we still have to face the EPS recession. That's what Jeffrey's arguing here. This is very Michael Burry-esque. Michael Burry, still another 50% to go. The second half is coming. The second wave of inflation is coming. That's going to actually end up pushing company earnings over the edge. These Q4 earnings are an anomaly, right? That's sort of your bear argument right now, your bear case right now. Now, when you compare to 2000, I think it's very useful to look at what I'm about to pull up. And no, it's not a reminder that this Friday at 11:59 p.m., the programs on Building Your Wealth have an expiring flash sale that we're doing just for this month. Also, it's worth noting for those of you who want to know, yes, you can shadow me, whether it's in person, if we're traveling, you travel with me. Travel's not guaranteed. If you want to shadow me, you can do that. I don't sell travel, I sell shadowing, right? If you want to join the stocks course to learn about, well, you get access to all my trades, whether they're good or bad, you get that. You get sort of my insight into the trades. But the psychology of money is very, very popular, as well as the Zero to Millionaire Real Estate Investing course, very, very popular as well. That's probably our most popular bundle is 1 and 2. If you want to get into managing properties yourself or renovating them and saving money on renovations, we've got options there. And of course, growing your income, we start the Elite Hustlers live stream this Saturday. And that's a custom live stream that we do with just people trying to grow their business this Saturday. So that's coming up. But before we keep going on El Corsez and that expiring flash sale, I want you to look at something here. I put this together and it really... Again, maybe I'm being Mr. Bullish over here, but I want you to compare for a moment with me the NASDAQ in the dot-com bubble, which the NASDAQ is tech heavy, right? So this is, let me make this very, very simple and very clear. Blue line equals tech, NDX 100, NASDAQ 100. White bars equal broad US market, right? The S&P 500. So, what I also want you to know is that this represents earnings per share, EPS. And when people compare the dot-com bubble to today, I personally think they're being slightly extreme. The reason I say that is because I want you to look at the earnings of the NASDAQ relative to the S&P 500 in the dot-com era. So let's zoom in for a moment into the dot-com era. Here is the dot-com bubble in this red square right here. In fact, maybe I could even highlight it in red. No, it's not working. Anyway, the point is, the blue line right here is under, and this is based on a factor of 100 starting here. So in other words, they're scaled at a factor of 100. So they're scaling together. That's really important for those of you statisticians who want to know how I set this up. It's set to a factor of 100 so we could see how they diverge in growth. But what I want you to see in the dot-com bubble is, first of all, earnings in the NASDAQ started below the S&P 500. Then earnings basically went to zero during the dot-com bubble. This is not earnings growth. This is straight up earnings. So that means in the NASDAQ, you had companies that were not very profitable. This was basically, the dot-com bubble was an era of speculation of profitless tech companies. That's what the dot-com bubble was. Now zoom out for a moment. Look at what has changed. Look at that. You should be able to understand this graph yourself. Look, I'm going to hide myself so you can see it yourself. Go, take a screenshot, okay? Now's your chance. Okay, good. Chance over. What's the difference? The blue line has vastly exceeded the white bars. The NASDAQ earnings have gone up by a factor of 847. So call it 8.08 times on a factor of 100, right? So 8x earnings on NASDAQ and 5x on S&P 500 relative to each other on a nominal basis starting then adjusted to a factor of 100. So this isn't like growth, right? We're not comparing growth rates. Obviously, if you start at 0, the growth rate is going to be higher. I'm actually talking net earnings. You had almost no actual earnings. Now, when you compare the actual earnings between the two, the NASDAQ has over 50% more earnings, more EPS than the S&P 500. So over time, the NASDAQ has become the earnings powerhouse, 62.5% greater earnings today than the S&P 500. So when you look back to the dot-com era, you look at speculation in tech stocks where there were no earnings, where earnings were below the S&P 500. Today, you look at big NASDAQ 100 tech companies, earnings are 62% higher than S&P 500 companies. In addition to that, let's go ahead and compare ratios of the dot-com era to today. These are the forward PE ratios for the S&P 500 in this case. So the S&P 500, and the whole point here is to compare to the dot-com era, right? I want to compare to what's happening in the dot-com era today. So again, we compare the NASDAQ and S&P 500. Now we're going to move away from that. We're just going to look at the S&P now and compare it to the valuations we have today compared to the dot-com era. During the dot-com era, the S&P 500 was selling for multiples between 24 and 26. We peaked out over here at roughly about 23. But the point is, where do we sit now on forward PE ratios for the S&P 500? This is where we sit right now. I drew a red line taking you all the way across. On the S&P 500, we're sitting slightly higher than where the S&P 500 ended up bottoming out. S&P 500 forward PE ratios ended up bottoming in about 2002 at about 14 to 15 times earnings, which is a little bit closer to where we bottomed out at the end of 2022. So you could potentially make the argument that if I draw a line across, that we've already hit the worst. We've already hit that bottom. You can see what's slightly maybe a couple points lower there in the dot-com era. So that's worth noting. That did we hit the bottom already? Or are we going to retest that bottom? We'll see. Over here, if you look at the mid-caps S&P 400, you're actually aligning where we are now roughly with the bottom of 02. Look at small caps, same story. All right, so that's interesting. So even though everybody likes to compare to the dot-com bubble, we're actually not too far off on a relative basis, comparing now to the bottom then in any of these charts. Again, you look at the S&P 600, small cap 600. Where we are now basically aligns perfectly with the bottom over here. In fact, we went lower on a forward PE basis, on the weekly basis, compared to the dot-com bubble. We've already been lower. Let's look over here at PEG ratios. This is a potential bear argument. When you look at S&P 500 growth rates, you are actually paying more for growth today than what you were paying there on the S&P 500. Now, this is where you could potentially make the argument, well, this is why you want to position out of the S&P 500 and into tech, because tech growth is more resilient than S&P 500 in total, where you've got a lot of that consumer staple, the consumer staple stocks sitting in the S&P 500, and we expect their earnings growth rate to falter relative to maybe tech that could still recover. We'll see. We'll see. Maybe that's at its bottom, right? So you've got mixed signals. I'll give it that. You've got mixed signals. Here's another one. Forward PE, growth versus value. Just gives you a growth versus value chart. Here you could see the bubble in growth. The bubble in growth then was a lot higher than what you have now. And if you look at the bottom of the growth bubble, it actually aligns with where we are now. So, conclusions, because there's a lot of information that I've provided here, right? I think it's very difficult to make a perfect comparison to any prior recession. In the 1970s, you had inflation expectations that were substantially higher and unanchored than the inflation expectations we have today. Even though we're getting these crazy reports that are suggesting, okay, in January we got some bad reports, that's bad. That becomes a trend. It is going to unanchor inflation expectations. That would be bad. But so far, it seems inflation expectations are stable. So we do have some differences to the 70s, which is good. And I'm not here to say this time is different. I'm not here to say YOLO everything on margin. Absolutely not. I've been saying for weeks, actually for months, quite frankly, I've been saying I'm mostly invested in this market. Do I think it makes sense to keep maybe 10, 15% cash on the sidelines? Yes. Do I think it makes sense to stay at a margin? Yes. Do I think it makes sense to YOLO call options? No. Only if you want to gamble. That's gambling. That can be fun, but it's gambling. So, conclusions. The NASDAQ has substantially greater earnings today than it did in the dot-com bubble. So I think the comparison to the dot-com bubble is somewhat unfair when you look at the NASDAQ. Also, our market has declined about 3 times as fast as the dot-com bubble. So there's an argument to be made that the markets have already bottomed. Is it possible that we're going to continue to get good reports, then bad reports? Good reports and bad reports. Absolutely. What do I think bottom line that's consistent with? Bottom line, I personally think it's very consistent with, there's our 3x faster than the NASDAQ decline. What does it end up being consistent with? This. A very, very bumpy Nike swoosh style recovery where we go up for a bit, we go down for a bit. We go up for a bit, we go down for a bit. But the trend line is likely, in my opinion, to be up. I do not think that we have a larger down leg ahead of us than what we had in October. I could be wrong. I don't have a crystal ball. But at least I'm going to have the balls to make a prediction. And I am making that prediction by aggregating all of the data that we do, and we're not always right, but as researchers, trying to understand what companies are actually saying. We're looking at actual forward-leading indicators and also aligning with what the Federal Reserve is saying, that January tends to be the month of seasonal revisions, weight revisions, and it may as well suggest pretty volatile surveys that we kind of want to throw out. Now, if we get a second report in a row of a trend, that's a problem. That's a potential red flag. So am I as bearish about this potential comparison to a dot-com recession? No, of course not, because otherwise I wouldn't be putting my money where my mouth is. I'm in, baby. But, does it make, again, sense to have a little bit of capital on the side for little buy the dip opportunities, psychologically help you through this sort of Nike swoosh recovery? Yes. Of course, you should form your own opinion with the research that I put together. Just because I'm a licensed financial advisor doesn't make me perfect. Just because I try to provide so much value every single day, not only on this channel, but in the courses on building your wealth and our course member live streams or on lectures to try to consolidate everything that I do to make it simple for you to get caught up with the way that I look at things. You don't have to agree with all my moves, but get caught up with my perspectives. I hope you join those. Use the flash sale link down below, expiring Friday. Doesn't mean I'm perfect about everything, but I do think I provide excellent perspective. And, obviously I wish you the best in all of your investments. But I am bullish on stocks, bearish on real estate still right now. That's been very, very consistent. So I like to bring you what some of the bears are saying, though, because I don't want to be blinded, right? I don't want to be blinded and blindsided. So I got to pay attention to what the bears are saying. And right now, they've got a pretty good argument that there's some things showing up a little bit more sticky than they should. That could be consistent with the Nike swoosh recovery. We'll see. We'll see. So far, I don't think there's enough of a suggestion that we deserve another leg down deeper than what we had in October.